Thank you, everybody. Welcome back to another episode of Portfolio Talks. Today, we have a special edition. We are joined with the CIO of Kinsted Wealth, Brent Smith, here to talk about investing, portfolio management, and a high level look at what the investment industry is kind of doing and what's available to you. Brent, thank you so much for doing this. We really appreciate you being here. For the audience that may not know how cool you are, can you give maybe a brief history of some of the things, because you've been attached to some pretty epic companies and set some high standards. Can you maybe elaborate for us?
Yeah, well, thanks for the invite. As you know, Tyson, I really do enjoy doing these, and I think if you would have asked my daughter if I'm cool, I don't think it would come across as the same as what I'm going to talk about. But no, again, thanks for the invite, and just a bit of background on myself. I've been in the industry for quite some time. I won't give the exact years. You could tell with the lack of hair, it's been a long time. Most of my career was probably spent with Franklin Templeton. On the multi-asset strategy side, I helped kind of form that group back around, I think, 19 or 2007 or 8, and I was with them for a number of years, spearheading the growth of the multi-asset strategies group. Managed a number of products in Canada back in the day, totaled about $8 billion at one point, but ultimately went down to the US to help grow the global group. By the time I left, we were probably about $43 billion or so, and I was managing products still in Canada, some in Europe and the US as well. So it's and then finally came to Kinsted, which has been incredibly fulfilling opportunity for me.
Yeah, we love everything that you're doing. It's such a cool look and a refreshing look at like what's available, and so I really appreciate what you're doing. One of the things that brought me to Kinsted that you do that's unique is blending the public securities, so the traditional stocks and bonds strategies, with privates, or sometimes they're called alts. Um, from your frame of view, how would you describe private investing or private investments to a brand new client?
Yeah. I think privates fall into, there's so many categories of privates, ranging from private infrastructure, private credit, private real estate, private equity, and so on. The way I would explain it, very simply, because I think there's a lot of myths out there on what privates are. Essentially, especially if you look at private equity, there really isn't any different between a publicly traded company that you can buy on the TSX or the S&P and a private company. The only difference between them is one is publicly traded and the other is not publicly traded. That's essentially the difference. They're all going concerns. There's private equity companies that generate $1 billion in revenue a year. Now, most private companies tend to be much smaller than some of the bigger publicly traded companies that we know. But at the end of the day, these are businesses that do very, very similar things to their cousins that are publicly traded. So not a huge degree of difference between what's private and what's public.
Okay. And then in your experience, do you find maybe not better quality, but maybe hidden gems that, because they're not public and public knowledge, do you see some that are amazing, like you can't believe that they're not publicly traded, or is it a little riskier? What is your perception sort of on that side of things?
Well, I'm not going to lie. I mean, a lot of private equity, are smaller companies. So
Okay.
there is inherently that size risk. But what we like about private equity in particular is that, these private equity companies tend to be bought and acquired by very large private equity firms. And so private equity firms, when they're acquiring a business, they're not just writing out a check and saying, we're taking 100% ownership, carry on the way you've been doing in the past. No, most of these private equity firms add a lot of value to hope to grow their businesses. They provide a lot of not just capital, but intellectual capital to help them grow either through, marketing, expenses, et cetera. And I'll give you an example. Actually, we had a meeting a couple of weeks ago with Brookfield, and Brookfield happens to be one of the largest private asset managers in the world, and they're very, very good at private equity, and they tend to acquire 100% of that business. Now, when you work at Brookfield on the private equity side, every intern or associate has to spend at least a year with one of their acquired businesses to learn the business, and everything that comes with managing a business. So it's not just, again, not writing out a check and say, carry on. They are helping to grow the businesses that they acquire. And I should point out that, publicly traded companies have really, over the past 25 years, there's way less publicly traded companies today than there were 20 years ago or 15 years ago. A lot of companies are just deciding to no longer go public because of, the regulatory environment and the quarterly reporting and all of that kind of stuff. So there's way less public companies today than there were, like I said, 15 years ago.
Absolutely. And so, like from a 30,000-foot portfolio manager view, does that make concentration in the market more of a concern, or is it just something that's on the radar?
Well, I think that, excuse me, is all you have to do is, excuse me, look at the S&P 500 today. It is becoming more and more and more concentrated between one sector, which is technology. I think there's a lot of areas within private equity, and I'm not even, when I talk about private equity, I'm not talking about venture capital or private real estate or infrastructure. Just going to talk about private equity. There's, there is a range of opportunities within private equity that you might not see within the publicly traded sector. There's a lot of great companies, for whatever reason, don't want to go public. And those are areas that if you're just focused on the public markets, you're just not going to get exposure to. Don't forget, here's another statistic, is that of companies in the US that generate over $100 million of revenue per year, 95% of those companies are not publicly traded. So 85% of those businesses are private companies. And so if you think that you're fully diversified by just investing in publicly traded companies, that's the furthest thing from the truth, is that you're missing out on a significant amount of opportunities if you just exclude the private markets from your portfolio.
That's quite a statement. And it really, that's been sort of like my awakening to how you do things, and a couple of other companies that are like yourselves. After being a 15-year mutual fund licensed advisor and having a very narrow shelf of choices, this is really refreshing. So one of the reasons that I looked for a partner like Kinsted was the blending of publicly traded equities as well as privates and real estate and some of the other strategies. How do you describe your guys' approach to building, portfolios for clients? And then how does that benefit clients, and what are the type of clients, I guess, that really seek to benefit from that?
Yeah, and I should point out too is that prior to coming to Kinsted, my career was focused predominantly on the retail market, and obviously when you're your focus is on the retail market, it excludes you from providing clients with exposure to this broad category called private assets. How we build portfolios, obviously portfolios are always built based upon a client's risk tolerance, return objectives, and time horizon, and so on. But in aggregate, when we're building portfolios, we always, every year we look at capital market assumptions, right? Every large organization, big institutional firms always put out their capital market assumptions, basically meaning this is what we think publicly traded stocks or US stocks or global stocks or fixed income are going to do over the next decade. And it's usually comes with, here's the risk associated with that. So that's kind of the starting point, is what does the market believe publicly traded stocks and bonds are going to do over the next decade. And that's the starting point. And I get that you look at the S&P 500 and global equities over the past number of years and then go, I should just be 100% invested there. But if you look at the assumptions for just say the S&P 500 over the next decade, it's probably somewhere in the 5 to 6.5% range. Now, if you look at private assets, most private assets that we look at are targeting, our expected returns are in some cases significantly higher than what we can expect within the public equity markets. So building portfolios is, if a client didn't have any liquidity issues, we'd probably say we'd have a pretty significant exposure to private assets. Just because of the nature of private assets, they're not as liquid as public markets. We just can't go and sell them tomorrow, given the nature of these things. But we're always balancing the return versus the liquidity need. So we're never going to have 100% private assets. Yes, public equities do provide returns. They do provide liquidity. So it's a balancing act. It's we try to balance what those expected returns are, the volatility of a client's portfolio, the liquidity needs, and so on. So I guess it could be a much longer conversation about how we put these things together. If I just look, I'll just throw a private credit, for example. Anyone could go on to BlackRock's. I encourage people, just go on to BlackRock, Google BlackRock capital market assumptions. They've got a great website, and you'll see, focus on US dollar ones. You'll see that the top expected return they have, I haven't checked it for a while, is private equity. The number 2 is private credit. Private credit, I forget what they're targeting right now, probably a 9.5 to 10% rate of return, but that's way higher than what's expected in public equities. So, if you don't have private credit in your portfolio, you really should think about why you don't have an asset class in there that most institutions expect it to provide you a higher rate of return than publicly traded equity with significantly less volatility over the next decade.
Yeah. And so for people who don't understand sort of what we're talking about, can you give an example of like how private credit would start and how it would work?
Yeah, you know what? Private credit is such it's grown tremendously over the past 15 years. And really, the growth of private credit was really a result of after the financial crisis, where banks really pulled back their lending to smaller businesses, and it created a vacuum, right? And that vacuum was basically filled in by institutions that said, well, there's a need for smaller businesses, and I'm not talking about businesses generating $500,000 of revenue. These are $100 million, 200 million, $500 million of revenue businesses that still need loans, and they were basically the banks kind of walked away from that, and that vacuum was filled by big financial institutions. I'll throw some names out there, like an Ares. They're a leader in private credit, or Blue Owl. These are massive firms that have $400-500 billion of assets under management, and those firms filled that vacuum by lending money to these private equity firms who needed capital. And it's basically a private credit is that one lender predominantly and one borrower. So it's this direct relationship from the lender to the borrower, where if you look at a publicly traded corporate bond, Manulife or Royal Bank bond, there could be thousands and thousands and thousands of investors in that, where typically with a private credit, it's just that one-to-one relationship.
Gotcha.
And the one thing I would point out about private credit, and it really we really saw this in 2022 when traditional fixed income performed very, very poorly because of that interest rate risk. As interest rates went up, the price of your bonds went down, and at one point I think they lost 10 to 11%. In contrast, private credit is what's called floating rate, and so it's tied. There's a fixed rate, but it's tied to a floating rate, which is usually the it's called SOFR, or the secured overnight funding or financing rate. And so as interest rates were going up, the yield that you were getting from private credit actually went up. So 2022 was a great year for private credit, and it really offset the risk from traditional fixed income securities.
Yeah, that was definitely a frustration that I experienced in all of my training, to make sure that you have a 60-40 portfolio or a 70-30 portfolio, and then it was extremely correlated in terms of the results that we were getting.
Yeah.
And as the advisor, you have no good answers for the client. Like, hey, I did everything I was told to do, didn't work.
It didn't work. No, and that's maybe one of the reasons why we've really seen this growth in private assets is due to the traditional assets are not behaving the way they used to. You buy fixed income. Why? Because it would offset the risk of equities. As equities would go down, fixed income would go up, and we didn't see that in 2022. In fact, the correlation between both of those assets is pretty tight today. And will it change at some point? I'm sure it will, but it's all about timing, and I don't see that correlation breaking down anytime soon.
Yeah. So, like, as a side question, this is not in my list of questions, but more out of curiosity now.
Mm-hmm.
Do you think there's going to be a rewriting or updating of the modern portfolio theory that's kind of the industry is based on, whether it's regulation or advisor behavior? Do you think it's going to be adjusted?
Well, when that Markowitz modern portfolio theory came out, and I don't even know what year that was. Don't forget, it was built basically around public markets, stocks and bonds. Private assets like private equity and private real estate and infrastructure and things like of that nature were not a real institutional. They were institutional, but not to the extent it is today. So when the modern portfolio theory is really based upon liquid public markets. Most big institutions have gotten away from that and have built their own, what's a properly diversified portfolio. And, even if you look at ultra high net worth individuals, their exposure to public markets is significantly lower than the average retail investor, which is, let's face it, it's probably close to 100% today. Institutions or foundation endowments like Yale and Harvard or Canadian Pension Plan, they've obviously adopted a much broader, more sophisticated approach to managing their money. And it you didn't ask me how we got into this, but or why we really look to enhance our platform, but it was exactly for that reason. It's you kind of look at what we would consider the very, very smart money, the Canadian pension plans, Yale Endowment, Harvard, etc., and go, they've been investing in private assets very, very successfully for decades. Like if that approach to wealth management is good enough for the CPP or these others, why aren't we doing it for our own private clients? And that's really the genesis of how we have evolved our investment platform over the past 6 years or so.
Yeah, that is on my list of questions to ask. But
Okay,
I guess
well,
I should
I
ask
jumped the
it at
queue.
the top. That's fine. So when you are constructing portfolios or you're looking at things, how would you say the underwriting process is for selecting, privates, whether it's equity, real estate, or infrastructure? How is it different from it would be on the publicly traded side when you're looking at, which stock selection you're going to pick next for the
Yeah,
portfolio?
I think there's a bit more due diligence involved when investing in private assets. And I should be very transparent when I say when we invest in private assets, listen, we don't go and say, listen, I think there's this great investment opportunity to invest in a toll road or a wind farm. We don't underwrite any of that. We don't have the expertise to do. What we do when we are investing in private assets is partnering with what we view as some of the best investors in their particular area of expertise in the world. So let's take a look at Brookfield. Brookfield is probably the largest investor, owner, operator of infrastructure in the world. You look at their track record, they're on Fund 10, Fund 11, Fund 12. You look at their historical track record. How do they add value to the businesses or the assets they buy? And you become comfortable with the firm, the team, the approach. You want to ensure that the success, that the people who have made those funds successful are still there, that the team has grown, and so on. And that's what a lot of our due diligence is focused on, the team and the firm. I could tell you, and why that is really critical is if you look at the dispersion of fund returns in the public sector, say a U.S. equity fund, the dispersion of returns between the top quartile and bottom quartile is very, very tight. If you look at the dispersion between the first quartile and fourth quartile in public or private assets, it's very, very broad. So you can have the first quartile manager average return, first quartile return of a private equity fund over time could be 25%, where over time the fourth quartile could be -10. So the dispersion is massive. So you want to ensure that you are investing, or you're investing your client's money with some of what you could consider some of the best managers of that particular asset class in the world. So that is very, very, very critical. And we think that the partners that we have committed our money to are some of the best in the world. And I should point out, like, because I'm sure there's a lot of people who are not familiar with the mechanics of what a private asset or a private infrastructure or real estate or private equity fund works. But typically, a fund manager might come out and say, we're raising $5 billion for, I'll use infrastructure, for this globally diversified, OECD infrastructure fund. Now, usually an investment, the timeline, or they call the investment period, is 5 years. So it may take you, if we commit, so we'll tend to commit 10 to 15, upwards of $20 million to a new fund. It could take us 4 to 5 years before all of that money is finally invested. So when we say that we're going to commit $20 million, we don't send out a check for $20 million. We will get what they call in the industry capital calls. The manager will send us an email and say, we've just acquired a business. We're going to be calling whatever it is, 15% of your committed capital in 3 weeks' time, send the money here. So it does take time for that capital that you've committed to be fully invested. So it really does take time to build these pools that we have done. And the reason we have done it, and I know I'm jumping all around here, but it does take time to build up a portfolio of high quality private assets. And thank God we started this 6 years ago. So a lot of the funds that we committed to 5, 6 years ago have now been fully called, and we should start seeing, as they say in the industry, harvesting their assets, which should translate into performance going forward.
Nice. I like that. That was a really good explanation, and I think that um, it that is definitely some of the questions that we get when we start talking about this with like our business owners and some of our professionals, and introducing the idea of like a multi-manager strategy.
Yeah.
So,
And I'll, sorry, I'm going to jump. Because I should have said, everything we do is in a pooled format, and the reason for that is that a big part of our pools are committed to these what we considered closed-end, drawdown, limited partnerships, where the minimum commitment tends to be in that $10 million USD range. So it would be very, even if you're worth $100 million, my gut tells me that no one is going to commit 10 million bucks to one investment. And so the only way we could do it where we're providing our clients with exposure to what we consider institutional quality investments is through a pool structure where the client, because these commitments or these funds have their lockups for 8 to 12 years. There's zero liquidity. And so we kind of, the way we've structured our pools, our clients are getting what we consider an illiquidity premium, but without being locked up for that 8 to 12 year period.
definitely a feature, because with some of the other shops that we interviewed, is they don't have that pool structure, and it might be 90 days till you get your money, and I think that that's fairly normal. At one of the previous companies that I worked for, they had their own real estate fund, and it was one of the mutual funds on their show, and it was like that. You submit your sell order, you get cash in like 90 days.
Yeah.
And so that seems fairly normal. What I was going to say is, one of the reasons that we like your shop, and we like the pool structure, and we like all of the multi-manager strategy is, Brent is not jumping on a plane with his briefcase to go look at an apartment building and buy a multifamily asset. So you're not the purchaser and the manager and the distributor of the fund. Is you have a little bit of hands off, and you're selecting partners that do that management. And the research scope then is so much bigger than just just Kinsted. You're getting access to all of these other professional back offices to underwrite and curate these deals.
Yeah, I mean, I don't even know how you would even compete with a Brookfield, a Morgan Stanley, a JP Morgan, a Goldman Sachs, and some of these other really high quality private asset firms, how you would even compete with them on sourcing deals. And that's what they're focused on. That's their expertise. And I'll give you an idea of one. One of our partners is called Henderson Park. It's a European or London-based private real estate firm. And I was talking to someone today about private real estate, and if that's an area you wanted to get into, where do you even start? And I'll give you a couple of examples of assets that they've bought. They bought the Waldorf Astoria in Edinburgh a couple of years ago. Um, we wouldn't have that expertise. We wouldn't even know where to start on how
Mm-hmm.
to underwrite something like that, and how much money they're going to put in for capital expenditures. They recently, about 4 or 5 months ago, they acquired the PGA National golf course and amenities in Palm Gardens, Florida. These are massive deals
Yeah.
that takes a tremendous amount of experience and expertise to do those kinds of deals. So that's why we're going to invest in your fund. We're just going to, let you guys do what makes you successful, and hopefully us and our clients are going to benefit from that.
Yeah. So when clients invest with Kinsted, they're a fractional owner of the PGA National Resort.
I'm not sure if they can go there and tell them and ask if they can get a discount at the hotel, but yeah, I mean, theoretically, you can say, yeah, absolutely. You've got a part ownership in the limited partnership that owns the PGA National or whatever hotel out there. Sure.
Yeah. That's fantastic. That makes
Yeah.
for such better conversations at your summer barbecues and
Yeah. What I like about private assets is I think a lot of the assets that you get exposure to, they'll really resonate with you. And I'm sure we own a lot that really resonate with you, Tyson, like professional sports franchises and that sort of thing. So it's something you're not going to get in the public markets, but it's something that you can I mean, the amount of investment opportunities and things you can get access to in the private markets can be overwhelming.
yeah. I was just going to bring that
Yeah,
up. So
yeah.
we just hosted an event and we flew Chris out from your team, head of portfolio management, and we did a swing into sports ownership event with a
Mhm.
dinner and golf simulator, and it was fun for everybody
Oh,
that was
cool.
involved.
Yeah.
And so I was wondering, could you talk a little bit about that? Because sports ownership is something that nobody talks about, and it seemed brand new to me. And it's fascinating how this works, and you guys have a stake in that fund.
Yeah. It's we got it through a feeder fund. There's not very many private equity firms whose sole focus is on sports ownership, and Arctos is one. And I should point out that the the NFL was the very last North American professional sports league to approve minority interests or minority purchasing by private equity firms. And that happened last August, September. And they were the very, very last one. And so the fund we're in, they bought 10% of the Buffalo Bills. So if
Okay.
you're a Bills fan, talk to Tyson, you get some exposure there. But yeah, I to be honest with you, a year and a half ago, 2 years ago, I had no idea that you can get exposure, minority interest to professional sports teams, like, NBA teams, Major League Baseball, NHL. I know our fund had some ownership in the Tampa Bay Lightning, but that was sold recently. Major League Baseball, Major League Soccer in the US, which happens to be one of the fastest growing from a valuation perspective in the
Yep.
world. F1 teams, Aston Martin, Major League Soccer or English Premier Division teams, Liverpool, and so on. What I love about professional sports franchises is it has a very, even though it's considered private equity, it behaves much different than typical private equity. Like a lot of, doesn't matter what the economy does, people are still going to watch football. They're going to go to their sports game, and what's really driving the valuation of professional sports is media rights. And so I don't see that going away anytime soon. So it does have a very different return profile from traditional private equity kinds of businesses. So, it's one that and I know that we're just doing some work on this. They've just launched an NFL only fund that we'll be able to get exposure to if we want to. So big fan of professional sports funds. I think that the NFL kind of green-lighted 4 firms. Only 2 of them have officially been approved, and one of them was Arctos.
Okay.
So, because I think the NFL is one of those, just feels like a huge cash cow. Everyone watch, media rights keep getting more and more and more expensive all the time. So,
Yeah.
although I won't mention this one, I won't mention names, but I had a call with them last week, and one of the recent acquisitions was an NBA team. They got a minority interest in the NBA team. Now, I'm not going to mention names, but because I'll get into trouble. But they were able to acquire part of a franchise where the owner of this minority interest grew up in a different city, and he had exposure to this, or he had a minority interest in another NBA team, not in his home city, and he wanted to an ownership opportunity came up to buy into his home city team. Not sure which city. And the NBA says you can only have interest in one franchise. So they approved his buying this other team. They said, but you've got to dispose of your current team within 12 months. 11 months later, it's like, I still haven't sold it. Well, tell you what, we're going to give you a month. And if you don't find a buyer in a month, you're going to have to dispose of your other team you just bought. So that what does that do? That creates an environment where everyone else knows he's got to sell. So you're going to be able to get it at a discount. And that's exactly what happens. So opportunities like that arise where someone essentially is a forced seller.
Wow.
That's what happens when you procrastinate for 11 months. So
that's true. That is very true.
Don't procrastinate.
That's right. That's right. One of the other veins that you guys have in your portfolio strategies is royalties, which is really eye-catching, and it's done in a couple of different ways. But do you have one that's like kind of your favorite, or that you like to talk about the most, that performs really well?
Yeah, I'm glad you brought that one up, because we've got a music royalty fund, which is just incredibly stable. Again, we like things that are not impacted tremendously by current economic environment. People are going to continue to listen to their music. I think, canceling your Shopify, or not Shopify, but Spotify account, it's probably the last thing you're going to do. So we like that. It's, pays out a 7.5% dividend yield per annum on a monthly basis, and I think it's done 11 to 12% per annum for us. Reason I'm glad you brought that up is in fact we're exploring another royalties fund, that is just not music royalties, but pharmaceutical royalties, uh, natural gas royalties, mining royalties, along with music royalties as well. And it's done phenomenal. So we're currently doing it's the firm that manages this there, it's a Zurich based or a Swiss based $150 billion private asset manager. So we're currently looking at that for it goes into if we invest in it, it goes into our strategic income, and it's just a income oriented investment opportunity that we really like. So yeah, we do like royalties. It gives you that stability of cash flow.
I like that. That's nice.
Mhm.
Um, One of the things that we had talked about previously was I had misunderstood the concept, but I thought you had a contract for a fighter jet investment, but it turns out it was a program for something else. Are you able to talk a little bit about that?
Yeah, one of our managers last year, I think it was last year or the year before, they had an opportunity to invest in it's called Top Aces. I think it's a Montreal-based firm that specializes in Air Force pilot training. And they have the contract for the Canadian military, the German Air Force, I think a bit of the British Air Force, and then they're trying to break into the US business. Now they essentially have a monopoly on and how that opportunity arose is that, and this is a bit of an educational part, is that a lot of when I commit or when a firm raises 5 billion, 10 billion, whatever it is, to raise capital and then buys all these businesses, once they fully invested that money and they've called all our money, they can't really go back to the well and say, hey, our Top Aces company needs an infusion of capital. Could you throw it? They can't do that. And so the only option they have for them is to, number one, sell it to another private equity firm that will grow that, raise more capital and grow that business. Or that what they do is they take it out of the fund, they relaunch it in a continuation fund and raise more capital. And the reason that one became available it was a Morgan Stanley fund that we were invested in, is they needed more capital because they had to buy some F-16s. Now, if I'm not mistaken, they were the only non-government agency or entity that was approved by the US government to buy F-16s. So they needed capital to buy some F-16s for their training, their pilot training. And that's how we got into that one. And it's one of these businesses that's probably going to grow over time, just because I think as I think NATO, what we're supposed to spend something like by 2035 up to 5% of our government budgets towards military spending. So it's one of these businesses I think that is going to continue to do very, very well. So didn't know there was a business out there that actually trained fighter pilots in I always thought that they were actually trained by our own, Canadian military, but no, a lot of
Right.
that is outsourced. So it's just interesting stories that you can tell clients.
Absolutely.
Yeah,
I think that's really cool.
yeah.
Um, is there any particular area of the portfolios or of the marketplace that you're looking at that you feel really bullish on over the next couple of years that's sort of exciting to look at?
You know what? I like, I think the area that really is really intriguing. Oh, there's so many, but I'll mention two. You know, because I talked a lot about private equity. I think venture capital and growth capital is very the marketplace looks at those venture capital and growth equity is different from private equity. Tends to
Okay.
be smaller businesses. They need a lot of capital to grow. There's so many businesses there, especially that are focused not necessarily on creating artificial intelligence, but are using artificial intelligence to grow their businesses. We were on a call in a fund we're probably going to invest in here sometime in the next couple months. When you hear these stories about, yeah, this business was generating $100 million of revenue 5 months ago, and now it's doing $400 million of revenue, the growth in that area is just phenomenal. So I think a lot of AI related businesses, but the area that I think is going to continue to offer tremendous investment opportunities is in the data, providing data. We know the growth of artificial intelligence is just the demand for data and data providers is just it exponential growth. And we were very fortunate to be provided with an opportunity to invest in it was a fund we invested in, but it was just on the credit side. They focused on digital infrastructure. We were provided an opportunity to invest in their in an equity exposure where they took 4 of their data businesses that they built, very large businesses, and offered us an opportunity to invest directly into those 4. And we just had a call with them yesterday, and one of the businesses is just about to sign very large contracts, and the business is essentially gonna triple.
Wow.
And one of the things I do like about private investing, especially private equity, real estate, and so on, which will intrigue investors, is that when you know, let's say the investment period for a private equity or private real estate, doesn't matter, private infrastructure, there's usually, you know, the first close, let's say the first close on that is January 1st, 2025. The last close, the final close, is 4 years later. Well, if you get into that final close 4 years later, you get in at cost. All right. That said, you do have to pay the initial investors what's called a equalization payment, and it's usually an interest rate and so on. But sometimes you can get into some of these at the later stages, and they've already been marked up 30 to 40 to 50%, and which is, you know, it's an arbitrage opportunity. Doesn't happen all the time. But this firm that we were talking to yesterday, one of their businesses, the one that's just going to be signing some pretty big deals, they are going to need more capital. So they're raising more capital for this particular business. They think it's by the time that capital that they're raising today is going to be called in about the later part of 26, that valuation might be up 50%. And you're able to get in at a significantly, not at 50% higher, but significantly lower. So besides the valuations and everything like that, I think the demand for data is just going to continue to grow exponentially, and that's where we're seeing tremendous opportunities, both on the credit side, where a firm is lending money to one of these, builders of data centers, or investing in the equity. I think we don't see any slowdown in the near term. And that's where, if you look at infrastructure, we deal with a couple of different infrastructure managers ranging from Brookfield to Morgan Stanley to IFM, which is a big Australian firm, to another couple, Manulife. A big part of their portfolios is in data centers, and
Okay.
that's just, infrastructure is continuing. There's a huge demand for data on the infrastructure side. So that's an area that I really, really like.
Yeah. And do you think this is just where the world is going, or is this like a gold rush?
That could be a gold rush. But man, it's I don't see it slowing down anytime soon. It's
Yeah,
just it just seems that AI, when you think about AI and the exponential, I don't want to use the word growth, but how things are evolving within artificial intelligence in such a incredibly quick. Think about Chat GPT 2 years ago and where we are today, and the like it from 2 years ago to today, it's just phenomenal. The what it offers you, that is even faster than when the internet started,
that's
right?
right.
It's so AI is just growing exponentially, and the demand not just on data centers, but the demand on power. And this is where you need to be able to access the power, because the demand on power for data centers is just off the charts. And I think that just I think that um, Alberta could be a big beneficiary of that down the road. I think that this firm we were chatting with yesterday, it's not just being able to access data or providing data, but what accessing that power, but it's also the cost of that real estate. And this firm is a leader in digital infrastructure, acquiring um, that real estate in Vancouver is, don't even bother. It's just too expensive. In Toronto, it's about $5 million an acre. Montreal, it's about a 1.5 million an acre. In Alberta or Calgary, it's about $800,000 an acre. So I would not be surprised at some point to see more very, very large businesses start looking at particularly Calgary and building some of these massive data centers. Fingers crossed, anyway. Listen, I live in Calgary, so
Right.
yeah.
All right. If we could transition just a little bit before we wrap up here.
Yep.
So we have clients that are medical professionals, business owners, wealthy families, and typically they make all of their money in one silo, right? And so they're extremely high income earning, and their job's likely not going to go away.
Mhm.
What's the benefit of them partnering with a firm like Kinsted to kind of manage the runway or the run out to prepare them for financial freedom?
Well, first of all, I think investing with Kinsted or just private assets in general, it should over time, and I shouldn't say this, but I think over time it could potentially enhance your returns. And number two, it's going to lower the volatility of your portfolio, which is, in my opinion, that's the goal of portfolio management. Can I increase the return at the same time as lower risk? I think you could do that with private assets. Um, I'm almost always amazed at when I see very ultra high net worth clients in Canada that are treated no differently than an investor who's investing $25 a month.
Yep.
Sure, you may be getting a different service level, you're treated much better, but at the end of the day, your investment portfolio is not much different than if I've got $2,500 to my name. It's publicly traded stocks and bonds. I think if you're a high income earner, you're building generational wealth, you should be treated like an ultra high net worth investor that lives over in Europe or anywhere where they have a much more significant exposure to private assets than 99% of high net worth investors in Canada. And it's kind of, and I think that's just there really isn't. Let's face it, the wealth management industry in Canada is owned by the banks, right?
Yep.
And there's really no incentive for banks to offer. Well, they're not going to offer you a an exposure to a Brookfield infrastructure fund, right? There's no incentive for that for them to do that. I'm not knocking on the banks, but it's just very frustrating for me to when I see the investment opportunities in the private space and the vast majority of Canadian investors and specifically high net worth clients are just never provided access to these. Yes, like if you go to a bank, can you get exposure to a lot of these what we call um, evergreen funds? Absolutely. And we invest in evergreen funds as well. There's some great high quality private asset evergreen funds. But a big focus of ours in our pools is not just evergreen funds. We need those to provide some liquidity, but it's these closed-end structures that are very difficult to access. And unless you're able to invest in a pool such as ours that provides you access to these closed-end structures in areas or assets that are just will never be available, in my opinion, in an evergreen structure. I think it's a travesty, and it's frustrating. And I think that ultra high net worth investors or individuals building up their nest egg, they should absolutely be provided with exposure to the same things that you know the Ontario teachers is investing in, or the Canadian pension plan is investing in. I've had discussions with a firm out of Asia called ESR. They're one of the largest um, real estate manager for in Asia, logistics and that sort of thing. One of their biggest relationships is with the Canadian pension plan, right? And so, where I spoke with them 4 or 5 years ago, kind of starting those conversations again. But it's, we just want to provide our clients with exposure and access to investment opportunities beyond what you can get in the retail markets, beyond what you can get just in semi-liquid or evergreen structures. And it's yeah, I mean that's our goal here is to really to provide. I almost look at what we do as providing a pension. Well, it's not just, it is a pension style approach to wealth management. And
Yeah.
you're providing clients with exposure to things that the Canadian pension plan is investing in, or Ontario Teachers, or Investment Management Corp of Ontario, or the Texas Retirement Pension Fund and CalPERS and so on. So that's what we're trying to do.
That's awesome. That really speaks to true diversification, and I think that, I mean, it's really needed, and I think it's being misunderstood especially at the advisor level in Canada. Is it's not we're not seeing true diversification, and then as we get into the markets where you're dealing with people who are more affluent or high net worth, um, I think the tools need to change. I once had a chief investment officer say to me that people concentrate on their careers and their businesses to get rich, and they should diversify to stay rich. And I think that's super important. You
Yep.
said that to me on our first call.
Concentrate to get rich and diversify to stay rich. Absolutely, you know.
Yeah,
And no one wants diversification in the public markets until you need diversification. And let's face it, you know, all you have to do is look at 2020 during COVID. Didn't matter what area within public equities you were invested in. Once I used the term, once the shit hits the fan, correlations go to one. And it
yeah,
doesn't matter what you're invested in on the equity markets, it's all gonna behave identically. And the minute you need that diversification, it really doesn't work in times of market stress. So
yeah,
I think what we bring to the table is it's not just an insurance policy against market volatility, but it's something that can, I do firmly believe that over time will enhance a client's experience.
yeah. Fantastic.
Yeah.
Um, Brent, thank you so much for doing this today.
It's already been an hour. Man, I could
It
talk for
has.
another two.
I know. I would love to let you, but Jessica
I
might
know,
get
I
mad
get
at
it.
me.
No worries. Maybe
Yeah,
another
but
time.
absolutely, we'd love to
Yeah.
have you back.
Yeah.
Thank you so much for doing this. This has been Brent Smith, CIO of Kinsted Wealth on Portfolio Talks, and we'll see you guys on the next one.
Awesome. Thanks so much for your time, or for the invite. Appreciate it.
You're most
All right.
welcome.
Okay. Okay. Take care.